Good
All
to
right,
see
folks,
you
so
again.
my next guest says that the April employment report is, quote, the beginning of the end of the catch-up effect. I want to bring in Bank of America Securities Head of U.S. Economics, Michael Gapen. Well, actually, I should note that your headline had a question mark at the end of it, so I'm glad you're here. What's the answer?
Well, the answer is probably, but 1 month doesn't make a trend. But we've been waiting for this, which is a lot of what's been propelling the economy and the labor market is this catch-up effect, meaning still in 2024, reopening effects from the pandemic are supporting the labor market. But at some point, the services side of the economy will have caught up, and then you would expect employment growth to slow. We think we're seeing the early signs of that today. We'll see if we get more validation in coming months.
Leisure wasn't that really as high as some of the prior months, though. So it's retail starting to pick up I'm not sure what that's all about. But what about the other parts of this report? It was a big miss. The miss consensus, and the whisper number was even higher than the overall number. So, what parts of it really came up short?
Yeah, the main one is, you mentioned, leisure and hospitality.
Right.
So that had been averaging maybe 50 to 75,000 jobs per month on average over the last year. It was only 5,000 today. I don't take a negative signal from that. Again, at some point, the sector will likely have caught up in terms of where employment should be, but that was where the big miss was. Secondarily, it was employment at the state and local level. So the other sector that's been adding jobs a lot has been education and health.
Right.
Some of that hiring takes place at the state and local level. That was also soft this month. So those were the two big misses in the report.
Where do you think we go from here then? You're saying it's too early to know if we've caught up. If you look at the JOLTS report, there still seem to be a fair amount of jobs open in those particular areas.
That's right. So I think it's right to expect employment growth will slow, but what's happening is it's slowing to rates of growth that we would consider normally solid or normally strong.
Well, on the wage side, though, are you happy with the wages? Because we're still in a relatively higher than normal inflationary period.
That's right.
These wages still, and people are struggling out there.
Yeah, so I'm at least from the perspective of, is demand too strong? Will wages fuel inflationary pressures to lead the
Powell
Fed?
said that he's not worried about wages fueling inflation. I thought that was interesting that he even brought that up, but I think he was itching to get that out there.
Yeah, well, from an economist's perspective, it's actually hard to prove the link between wages and services inflation. You'd think it would be easy, but it's not straightforward. So yes, some moderation in wage growth is helpful for the economy right now. Overall, wage growth is still in line, if not slightly ahead of inflation. So yeah, there's a balance there. But the signal from this report, I think, is the risk of overheating is reduced. It should leave the door open for Fed rate cuts later this year. We can debate on when, but I think that's still the likely course of action.
What if though, the shift goes too far? And I'm going to point to ISM numbers.
Sure.
Manufacturing, which went to contraction, which has been a contraction, but there's certain parts of it that are really starting to struggle a lot, even more. But services today, overshadowed by this jobs report, I thought was somewhat of a shocking number. Came in below consensus, contraction for the first time after 15 months in a row. And the part where both of them are linked, manufacturing and services, prices keep going up. Mm-hmm. That's a heck of a combination. So the headline is coming down, but the prices are going up. That's the exact opposite of what we want. That's not a soft landing, is it?
Right. Well, at least to the first part of your question on when to get concerned, right? Some slowing in employment growth is fine and healthy and Goldilocks. So what I would say is look at two things. When employment growth slows further and we get indications that layoffs are picking up, right? That's the bad combination. On the other side of it, I would just say it's hard to have every data point aligned to tell a consistent signal every month.
Yeah, I think prices have been going up 4 or 5 months for both of them, and no one's really talking about it.
Well, that mirrors what we've been seeing in inflation. Inflation did outperform in the first quarter. So I'm not here to say we're out of the woods on that. I think the risk is still that inflation's too sticky and maybe the Fed just gets delayed. But we had, say, 3 to 4 months of kind of bad price data, and we had one employment report today that throws a little cold water on that. So net, I still think it's a world where the Fed needs to be cautious, wait, take their time, and when they ease, and this is still key, ease slowly.
Ease slowly.
Yep.
All right. Great stuff, Michael.
Thank you.
Appreciate it. Thank you.